Welcome to today's explainer. Look, if you're a focused learner trying to cut through all the financial noise and get straight to the good stuff, you are absolutely in the right place. Today, we're looking at a slate of earnings that just hit differently this year. I mean, if the Q2 financial prints were an NBA playoffs bracket, we would basically have a Cinderella run, a super hard-fought defensive win, and a surprise trade that completely upends the whole league. We're going to cover three very distinct styles of victory today, and honestly, they each tell a fascinating story about exactly where money is moving right now. Okay, let's dive into this. Here is our structured roadmap for a fast-paced breakdown of three massive fintech flexes. We'll start with the Q2 playoff bracket to set the stage. Then we're going to look at Interactive Brokers' offensive blowout. After that, we'll pivot over to Capital One's defensive stand, follow it up with the Apple and Klarna blockbuster trade, and finally, bring it all home with the post-game wrap-up. All right, Section 1, the Q2 playoff bracket, setting the stage for earnings season. Let's jump right into our first matchup in Section 2, IBKR's offensive blowout, unstoppable margins and record revenues. Now, what's really interesting about this first story is the sheer dominance of Interactive Brokers, or IBKR. If this were a basketball game, they literally just hit every single three-pointer they took. They didn't just beat Wall Street's second quarter estimates, they absolutely obliterated them. Look at this profitability. IBKR reported a staggering 77% pre-tax profit margin. And no, that is not a one-off fluke. This is actually their seventh straight quarter staying above 70%. As the quote here says, that is Bezos in 2021 Amazon margins territory, but for a brokerage firm. It is incredibly difficult to maintain that level of efficiency at scale, but man, they are making it look easy. Let's rapid fire some of the stats driving this blowout because the growth numbers are just massive. Commissions, up 30% year over year. Client equity surged 40% to a whopping $930 billion. Plus, they saw 34% new account growth and a 27% jump in client cash balances. And, all of this success is built on a very specific foundation. Thomas Peterffy founded the company back in 1978. He's actually still the chairman, by the way, and they built their whole reputation on offering ultra-low-cost, automated trading for power users and international clients. That long-term discipline is exactly what's paying off today. But here's the thing. This quarter wasn't just them doing more of the same. They are aggressively pushing boundaries. Case in point, they just launched retail access to the SpaceX IPO in Europe. Providing retail investors an on-ramp to private market equity like SpaceX is a massive flex. It's a kind of headline that makes traditional finance folks seriously sit up and take notice. I mean, it's basically like if the Avengers let a rookie suit up mid-endgame. It's highly exclusive, incredibly powerful, and frankly, makes the competition a little jealous. Which brings us to the ultimate takeaway here. IBKR isn't just beating estimates, they're actively building the on-ramp to private markets way before anyone else gets there. Oh, and on top of that SpaceX news, they launched trading in Korea, they rolled out crypto trading across Europe, and they even secured preliminary conditional approval from the OCC for a national trust bank charter. They're playing a highly aggressive, completely unstoppable offensive game right now. Sound the quarterly buzzer because we are pivoting to a totally different style of play. Section 3, Capital One's defensive stand, healing fundamentals, and the Discover game plan. Founded in McLean, Virginia in 1994, and impressively still led by CEO Richard Fairbank, Capital One's quarter is a masterclass in a strategic defensive victory. If we look at the top-line scoreboard, they posted Q2 revenue of $15.85 billion. That's up 26.9% year over year. And look at their adjusted earnings per share, coming in at $5.81 against a consensus estimate of $4.85. That is nearly a 20% beat. But beating estimates by 20% aside, the real story here, the true defensive stand, is actually found a bit deeper in their underlying credit quality. So, the crucial point is right here with this massive number, $1.1 billion. That represents the quarter-over-quarter drop in Capital One's provision for credit losses, which brings it down to $3.0 billion. Think about it. When a lender is setting aside over $1 billion less for potential bad loans, that means their credit book is healing. The defense is holding strong. And to back that up, their net charge-off rate declined by 22 basis points to 3.23%. What this really proves is that their massive Discover acquisition wasn't just some big balance sheet flex. It's actually paying off in the real numbers. They've got major backbook conversion waves for the integration planned out for July, October, and January, and they expect the combined platform to fully hit its stride by 2027. So the credit book is healing even faster than expected. However, the market reaction was kind of funny at first glance. Despite these healing fundamentals, Wall Street just wasn't fully convinced. Capital One shares actually slipped about 7.6% in after-hours trading, mostly due to profit-taking after a really strong run. It's a lot like a sports team that just finished training camp right after a blockbuster trade, you know? The back score of a single game doesn't tell the whole story yet, but the underlying fundamentals and those defensive structures are absolutely trending in the right direction. Now, let's transition to the final matchup of our bracket. Section 4, the Apple-Klarna blockbuster trade, the ultimate industry cosign. So this is our surprise trade where the buy now, pay later sector just got its absolute biggest industry endorsement yet. Klarna, which was founded in Stockholm back in 2005, has spent 2 decades working tirelessly to shed this old reputation of just being a sketchy checkout button on e-commerce sites. They wanted to be seen as real embedded financial infrastructure. Well, they just evolved in a massive way by landing the ultimate signature client. And this brilliantly illustrates exactly what they pulled off. Apple partnered with Klarna as the financial backer for their new leasing program that launched July 28th. The terms are beautifully simple. iPhones and Apple Watches go on 24-month terms, while Macs and iPads get 36-month terms. It's designed to soften the blow of those ever-rising device prices. And the best part for us consumers? It just requires a simple credit check. You can pay the device off early, upgrade before the lease ends, keep it, or just hand it back. It is basically a car lease for your iPhone. The sheer magnitude of this partnership literally cannot be overstated. I mean, Apple is famously allergic to letting anyone else touch their customer experience. So getting them to trust you as their financing partner, that is the fintech equivalent of getting drafted first overall. It completely changes Klarna's trajectory, and it gives them the most valuable stamp of approval in consumer tech. Which brings us nicely to Section 5, the post-game wrap-up, what it all means for the fintech sector. Let's move to our recap and see how this all builds together. We've seen 3 completely different styles of play today, proving that success in fintech definitely doesn't rely on a single playbook. First, we had IBKR, totally redefining the brokerage with unstoppable margins, global expansion, and exclusive private market access. Then we had Capital One, proving that strategic acquisitions and tight defensive credit management can heal a balance sheet right on schedule. And finally, Klarna securing the ultimate tech alliance by stepping up as Apple's financing plug. So what does this all mean for you? As you look at your own investments or study the broader market, I want to leave you with this question. Which of these strategies, unstoppable margins, defensive healing, or massive big tech partnerships, do you think will ultimately dominate the future of fintech? Because as we saw today, there are clearly multiple ways to win a championship. Thank you so much for joining me on this explainer. Keep analyzing, keep learning, and I'll catch you next time as we break down the market's next big moves.